Hello class. In chapter 12, before I get started in one of the problems, I want to take a few minutes to go over some things with you on S corporations just because they are a little bit more technical than the partnerships. I'll leave these notes up here for you as part of the video even when we go down to work the problem so that you can pause them and go back to them if you would like. An S corporation gets its name because it is a small business corporation. There are specific requirements in terms of the maximum number of shareholders you can have, which is 100. It has to be a domestic corporation. Various other requirements. They're listed in your book. You just make sure you kind of go over those. They have to elect to be treated as an S corporation. So really what it is, it's a smaller corporation that has elected to be treated as a partnership or as a pass-through entity. So in a sense, that's what you're doing with an S corporation. You're being incorporated, but then you're acting for tax purposes like your partnership. An S election can be revoked. A business can change its mind and decide no longer to be an S corporation, or they can lose it if they violate one of the requirements that are listed in your chapter. Quickly, the other three things before we get to the problem, because you're asked to identify these things, is AEP, stands for Accumulated Earnings and Profits. What that relates to is any earnings that have been accumulated, or what you're used to calling retained earnings, during the C corporation years. So if you have a C corporation, which was in effect what happened where I used to work, we were a C corporation, we elected to become an S corporation, any retained earnings, accumulated earnings up to that point, were captured in AEP. If, however, though a S Corp is formed initially and is never a C Corp, then they're not going to have accumulated earnings and profits. And they also could also not have accumulated earnings and profits even if they were a C Corporation if they did not have any positive retained earnings. When you distribute from your AEP, those are considered dividends. Now, AAA is the Accumulated Adjustments Account. What it does is it looks at any earnings that have been undistributed of an S corporation, but that they have been taxed but not distributed, because the partners or the members of the S corporation are each going to be taxed based on their share of the earnings. So if they have not been distributed, then those amounts are in AAA. AAA is what we call it. Distributions from AAA are considered tax-free since they've been previously taxed. AAA, when an S corporation starts, begins with a zero balance. The last one that I have up there is OAA. OAA is my other adjustments account. It reflects items that affect the basis, the stock basis of the individual member, but not the accumulated adjustments accounts. Examples are things like tax-exempt income, like your income from your state and municipal bonds, and any related non-deductible expenses, like any expenses associated with raising tax-exempt income. Distributions are made from other adjustments accounts after the accumulated earnings and profits and AAA are zero, so you tap those out first and then they become tax-free. So with that information, we're going to move to problem chapter 35. And in chapter 35, you've got an entity here that basically it says it's calendar year. Cougars formed 1120S, and that's the 1120S is the S Corporation's tax return. Shows non-separately stated ordinary income of $80,000 for the year. It says Johnny owns 40% of Cougar, and he owns that stock throughout the whole year. And then they give us some information. In A, they want us to compute Cougar's book income or loss. So what they've given you here is what the taxable income and loss. Now they want you to compute the book income and loss. Then they want us to compute Johnny's ending stock basis. And then they want us to compute Cougar's ending AAA balance. So I thought this would be a good problem because it's the most technical of the ones I've assigned you, and it also kind of covers the basics. So let's get started. Okay, in A, let's go ahead and look at what we're dealing with. We're trying to compute book income. Okay, So let's just start off here with our ordinary income. This is per the 1120S. Okay. Ordinary income per the 1120S, we said was 80,000. Okay. And I'll look at the formatting in a little bit. All right, we're going to look at our separately stated items. So we're going to add our separately stated items. What separately stated items are things that will have characteristics unique to the individual members. We talked about that in Chapter 10, where you looked at items such as charitable contributions, long-term capital gains, tax-exempt interest, things like that, dividends that may have different characteristics depending on who the individual partners or members are. Okay, so let's look at our separately stated items. First one we're going to look at is our dividends received. You look in the problem, you've got dividends received showing up as 5,000 being my 40% share. So you actually have to go to the dividends received. Well, the 40% share will be Johnny's. Right now we're going to do them in total. So if I go down the list and I look at what was given to you in the problem, you'll see that you've got dividends received of $5,000. Right, next item, let's look at our tax-exempt interest. That's going to be $3,000. Next item is going to be recovery of state taxes. What this is the prior year taxes. It's on the list where you had the refund of the prior year taxes that's showing on your list about halfway down for $5,000. Our long-term capital gain, we're going to abbreviate that. Okay, our long-term capital gain is $14,000. Now those are going to be my separately stated items that I'm going to add, and then I'm going to subtract other separately stated items. So we're going to add some separately stated and subtract. You could have done this all together just as well. Just listed them all as one. Okay. So my subtractions then are my charitable contributions. We already talked about those, because depending on who the member of the partner is, they have different limitations, and depending on how much else they've given outside of what's being passed through this entity. You've got your long-term capital loss. This is $7,000, and a short-term capital loss of $6,000. I think we'll just sum them up and then make them a minus. Okay. So let's just go ahead here. I think I'm going to sum these here. Let's go here. Let's do our auto sum. We're going to pick it from here. All right, and those are going to be addition items. Then what I'm going to do, let's copy this and put it in here. Okay, and that's going to give me 19,000. The only thing I'm going to do down here is I'm going to make that a negative, because those are going to be items that are subtracted. And by doing that, then I can come down here and give me a total for book income and answer question 8. So we'll just do an auto sum on that. And we get our book income is $88,000. What we're going to find out now in that $88,000 is that when we go into do part B, where it says compute Johnny's ending stock basis, we're going to look at his percentage. Okay. Let's go jump down to B. Right, this is Johnny's. So let's look at what his beginning stock basis is. Oops. It's given to us in the problem that Johnny's beginning stock basis is $32,000. we're going to add the things that are going to increase his basis. First thing is going to be the share of ordinary income. Okay. All right. So we're going to look at his share of the ordinary income. All right, because we're looking at stock basis as it relates, we're going to use not the book income, this $88,000 right here, not that. Go ahead and underline that. But we're actually going to take his percentage of the taxable income. So we're going to put equals to 80,000, which was given to us, times 0.4 versus 32,000. Okay, so that's important. Please notice that you want to add into his stock basis his share of taxable income, not book income. All right, tax exempt interest. Now we're just going to go to the separately stated items, and these here again, we're going to take in consideration his 40%. So if you go up here, I think I'm just going to go pull these so you can see there's my tax exempt interest times 0.4. There's my 1,200 that I got there. Let's go ahead and do our dividends received. Dividends received, that times 0.4. Okay. Let's do our recovery of state taxes. This is our refund of prior years. Go back here and pick up that times 0.4. Our long-term capital gain. Times 0.4, 5,600. And the only other thing that we have is if you look down the list, and please don't forget this as it impacts the basis, we also have down here that he made an additional stock purchases. So this is like the third item from the bottom on the list of transactions in your book. On page 1239, you'll see 9,000. Now because that's his own personal additional investment, you do not take 40%. And I'm going to put by Johnny directly. So you're going to add in the full 9,000 for that. Okay, let's go ahead and copy that. Probably going to be the quickest way. But we do not have B42, so we're going to change that formula and make it go all the way to B40. Alright, so those are going to be the things that increase basis. So now let's look at the items that decrease basis. Some subtractions. Okay, so we're going to go up here and look at our charitable contributions. Here we're going to pull our 6,000 times 0.4, and I think I'll just copy that. Save us a little time here. Our long-term capital loss. That 0.4 equals that. Now here, if we had any additional subtractions, like let's say he had some withdrawals to him personally, you would also include those at this point. Okay. So those are my subtractions. This should give me now an ending stock basis. So we can do this. Ending stock basis of 44.2, but I don't think it included us all the way up. So let's include that. And that gives me to an ending stock basis. Okay. Should get us to an ending stock base. I still don't think our formulas got us high enough. It did not. So we need to make sure we're going all the way up to B38. And it's 76.2. So now C says to compute Cougar's ending AAA balance. So I especially like this because this is the first time we've really had the opportunity to work with a AAA account. So it's giving you some exposure to accumulated adjustments account. So we're going to look at our beginning AAA. That's given to you in the problem. It is, let's see, the second line from the bottom, and it tells me, let's go ahead and put it over here. It's at 31,000. So now we're going to be looking for those items that increase. So let's go ahead and do some adds again. What are things that increase that accumulated adjustments account? First thing that will increase it will be your ordinary income. Here again, we're basing this on tax, so we want to use the 80,000. The 88,000 we computed in Part A was just so we could show how you reconcile from book income to taxable income. We're next going to look at any dividends received. So you can kind of see the flow here. We're using all pretty much the same things that we did before. In other words, we can go up here just to kind of show you that I'm pulling the same thing, the dividends received. We're going to also look at the recovery of state taxes. That's my refund of prior year state taxes. And we're going to pull those. And then we're going to also pull my long-term capital gain. In total, 14,000. Now if you'll notice, the only thing I haven't pulled from up here that we add as a separately stated item was this tax-exempt interest. The reason that you don't add the tax-exempt interest is that's going to be one of those items that I talked about up here initially in my notes that is going to flow into OAA. And what OAA is that reflects items that affect basis but not AAA. Examples are tax-exempt income. So tax-exempt income affects basis, but it doesn't affect AAA. So you don't use it in AAA, you accumulate that in your other adjustments account. So that's not going to be part of the formula with what we use here. Okay. And so if we want to come over here and do our auto sum, sum these. Okay, and right now that's going to give me my additions. Now let's go through and do our subtractions. Charitable contributions. So, like I said, now I'm pulling these up in total. So I'm going to use the whole 6,000. I'm also going to pick up, I'm just going to go ahead and copy these, the long-term capital loss and the short-term capital loss. Alright, so I've got those listed. Those are going to be my subtractions. So we will do an auto sum, these three, and make that a negative because it is a subtraction. And then what we'll end up getting is our ending AAA. Now, had we incurred any expenses associated with generating the tax-exempt income, those likewise would not be included here. So, in my AAA account. So, we'll do a sum here. These. And when we do, we're going to get an ending balance in my AAA of 116,000. Alright, there's your problem 35. We have gone through, we have computed the Cougar's book income, so we did the reconciliation from taxable income to book income. We computed the ending stock basis for Johnny, and we looked at the AAA account. So hopefully that'll kind of help you get an overall understanding of what we have done in Chapter 12. Thank you.